Thank you very much, Max. I want to go through 2 slides today in 10 minutes or so. This will be the second slide. I want to go through a very complicated, purposely complicated slide. So look at the one that says accelerating the life cycle of new companies. Everybody have that?
Turn it on. Okay.
Now, having been a healthcare analyst for 40 years, I specialize on simple slides. And this one is purposely complicated because I wanted to show what it takes to get a new drug or device to the marketplace over 10 or 15 years. So let's look at does everybody have a copy of this in front of them? Because I'm going to go through this before we go through that. I have plenty of extras. If anyone doesn't have, just raise your hand. Okay, let's start at the top left hand of the page, where it says technical-based universities. So much of the technology for pharmaceutical medical devices come out of big universities, big academic medical centers that have usually can have big university and a big medical center connected to each other. There's about 125 medical schools in the United States. So these ideas come from our smart scientists, engineers, professors, and then we go across the page at the top. So these great ideas then become products, move into the laboratory, into animals, and then some corporation might get formed by the professor or some business friends. And they get money from friends and family, and they run out of friends and family. They struggle to get to phase 1, and they get to phase 1 and they run out of money. So then we come to phase 2, which is the valley of death, so to speak, where it's very difficult to get venture capital funding, but it can be gotten. But the professors, the business people have to spend so much time fundraising. And then they struggle. Many of them fail, but they get to phase 2. They then get to phase 3. And the costs keep multiplying. So phase 1 might be $10 million. Phase 2 can be 25 or more. And then phase 3 can be 50, 100, 200, depending on what you're trying to develop. And then now we're at the bottom right. And then this company will try to get approval in Europe, try to get some growth capital to market the product in Europe, then get approval in the US, then try to get government and insurance carrier reimbursement, start marketing. Now we're 12 years later. The company's lost $232 million or more. They'll have some sales, they hopefully exit, and the people make a lot of money, and they give it to the universities in gratitude for teaching them the science. So this is a 10, 15-year process, very tedious, full of landmines, full of hurdles. It's like an analogy, you're running in the Olympics, and there's 10 hurdles in the 100-yard dash. You get to hurdle number 9, and then the starter or the person with the gun or watching who goes through the tape first announces that I'm sorry I didn't mention this to you before, but there's another 5 hurdles. And you go, well, wait a minute, I practiced for 10 hurdles to last forever, and now you told me there's another 5 hurdles. Yes, just shut up and keep running. And then you get to the 14th hurdle, and they say, I forgot to tell you there's another 3 hurdles. And so one by one, the runners start falling at the various hurdles because they practiced for 10 hurdles, or they had enough money, so to speak. And then they fall at hurdle number 11, 12, 13, 14. And one of these runners miraculously jumps over 18 hurdles, and they get the prize. And then there's 17 guys, lying down on the track, having been hurt their legs or ankles along the way. So this is a very tedious process. So it needs a special type of investor who's either smart enough or dumb enough to finance this process. And the ones who are smart enough are the ones that you hear about. It's like when you go to Las Vegas, and in Las Vegas, all the casinos are when you check in at the hotel, you have to walk through the casino to get to your room, so that they force you to go through the casino, and then you hear all these ching 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 of everyone making money. Of course, you don't hear the non ching ching chings of the other 98% of people who are losing money. So the people who make money give speeches, and they're in the Forbes magazine, and we're so proud of them. But we're talking about a small minority. So the question is, how should an investor react to this mess, or this problem, or this challenge, or this opportunity? So I created this slide, which was up here, but it's you have it in front of you, okay? But it's also in front of you if you just flip over what we just discussed. So one of the challenges in the investment world is the investment world, like the science world or any world, government world, is full of silos. So there's, for example, look at where it says asset category for public equity in the stock market. There's funds that just focus on large market capitalization companies. There's funds that focus on middle capitalization companies and funds that focus on small capitalization companies. Then, but rarely is there a fund that does all three at the same time, because the investment professionals, the consultants, the pension advisors say that you're supposed to focus, and if you focus on large capitalization, you shouldn't waste your time on middle capitalization companies. If you focus on middle-sized companies, you shouldn't waste your time on small companies. Then we have, I'll skip over pipes, I'll explain that in 1 minute. Then we come to venture capital, where you're investing in private companies. And private companies also have phases. You can have a young company, what we call a Series A, Series B, a Series C, D, E, F, just different timelines. And so we have a whole venture capital community focused on private equity. Now, there is a phase in between venture capital and public equity, where companies are small companies. They are public, but it's really public venture capital. I mean, they're losing money. They have all the characteristics of a venture capital company, but they happen to be public. And these companies are also starved for capital, and they, when a large investor approaches them with what we call a private investment in public equity, also known as a PIPE, in the stock of this theoretical company is at $5, and a large investor says, I'll invest $10 million at $4.25. So I'll get an immediate discount. And you can do that. And small companies will take the $10 million from this pipe, so to speak. This investor may well ask to be on the board. And it's really venture capital, but it's venture capital for public companies. And then another category is venture debt. There's certain companies that don't want any equity in companies like this, but they're happy to loan money. We call that venture debt. So my key point here is there's different people who do different things in these asset categories. And the world's full of silos. I personally have spent 40 years investing in healthcare. I don't like silos. The way I look at life is you should follow the opportunity. If you have money and you're responsible for managing those funds, you should move the money to any company at any stage of its life, depending upon what value you see, what opportunity you see, what risk you see. And there really should be one investment manager managing these asset categories, not a whole series of investors managing a silo. So let me show you how this non-silo asset management would work. Well, it depends how much money you have. Obviously, the more money you have under management, the more risk you can take. So let's just say, just for argument's sake, what if you only had a portfolio of $10 million? Well, you wouldn't do any venture capital. By definition, you don't have enough money to play in the venture capital community. And you wouldn't do any private investments in public equity or pipes. You're too small. And you would basically put 60%, 70% of your money in small and medium capitalization companies. And you'd have a public portfolio, but you wouldn't do anything particularly adventurous other than invest in small companies. Now, when you get to 100 million, you can see you can become more adventurous. You can put money into the pipes and into venture capital. And if you had $1 billion under management, you could put even more money into venture capital. So then I give you a listing for the dividend yield and the potential appreciation of the asset categories, and you put it together, and you should be able to make 10 or 12% on your money. If you get lucky, obviously you can do 15, 20. If you get unlucky, you do 0 or worse if you do. Although it's hard to do worse than 0 in the public markets because you just wait a few years and everything comes back. If you just wait more. So this just gives you an idea of how to invest without silos, which is the way I look at life. Having spent 40 years working in different silos, I don't believe in silos. So that's the end of my talk, and I guess it's time for some questions.